Hi, I'm Jim Elder, a director in our Corporate and Financial Institutions segment at S&P Capital IQ. We are back again to discuss the key findings of our Q4 2014 edition of Fixed Income IQ. This is a quarterly publication produced by S&P Capital IQ that leverages proprietary analytics and data to provide you with quarterly trends in the global fixed income markets. I'm here today with one of the authors, Jay Bankaria, a senior manager in the Investment Management segment. I'll start with market performance. Fixed income lagged equities in the U.S. during the fourth quarter as equities were setting record highs. U.S. investment-grade indices rose slightly while high yield fell, impacted heavily by slumping oil prices. We saw a different story in Europe and Latin America as equities fell on growth in oil concerns. European fixed income rose while Latin American fixed income fell, but still outpaced regional stock markets by a large margin. Relative pricing of risk is a big topic this quarter in the fixed income markets. Jay, can you step through some of the regional differences in the bond markets between the U.S. and Europe?
Yeah, thanks, Jim. Yeah, we've definitely noticed diverging trends in Z-spreads with the U.S. Z-spreads widening, whereas in Europe, spreads have tightened. So let's take a look at the Z-spread term structure across all ratings categories. The dotted line here represents the spreads a quarter ago, whereas the regular line represents the spreads this quarter. Similar colored lines are the same as ratings categories. So starting with the U.S., there's a widening of spreads quarter over quarter throughout all ratings categories. Within investment grade space, we observe a parallel shift upward throughout the term structure. In high yield, we observe a steepening in the double B curve, while in the single B curve that has actually flattened. Now this widening occurs as investors move into more risky asset classes at the end of Q4. Next, if we look at euro-denominated curves, we see a slight improvement in credit spreads throughout the credit spectrum with the exception of single B-rated companies. We observe mainly a parallel shift in the term structure as credit spreads do tighten. And this movement could be due to economic policies that support the credit environment as well as investors moving to safer asset classes as growth concerns as well as deflation concerns continue to arise in Europe.
Very interesting. Now stepping back to market performance, between the U.S., Latin America, and Europe, only European high yield was in positive territory for the quarter. Energy is definitely a big story across the Americas. What are your thoughts on the risk present within the energy sector?
Yes, definitely with the fall of oil prices, risk has gone up significantly in the energy sector. One indicator that we are monitoring is an equity market-based probability of default. And this indicator shows credit risk based off of movements in the equity market. So in this next chart, we're taking a look at energy risk from US, Europe, and Latin America compared to the overall probability of default within these three regions. One thing you'll notice that probability of default has gone up significantly for the energy sector, with Latin America having the most risk, followed by US and then Europe. And one thing, if we take a look at the probability of default numbers and then map them to a credit score based off of historical rated defaults for each region, we're observing the median rating for US energy companies at a B+, similar B+ within European companies, and a median rating of a B- for Latin American companies in the energy sector.
Thanks, Jay. We, along with the entire market, are watching oil prices intently as we await the shakeout from energy firms. We will see whether they can sustain the volumes of debt they have issued over the past few years, while oil prices were double what they are now. In our latest edition of Fixed Income IQ, we cover this, as well as more trends in the market, credit quality, and financial ratios across North America, Europe, and Latin America. So please download a copy, and we'll see you next quarter.